answer a couple questions that I've been getting ever since we launched our video. The first question is, how do I find a good investment, or how do I find a good deal? Now, if we're following up from the video and I said, you know, you're going to start off with buying a house, you're not necessarily looking for an investment the same way you normally would, because you're actually looking for a place for you to live, so it needs to be an acceptable place for you to live. But if you are looking for a house just as an investment, not the one that you're living in, which is okay to do, but that was not part of the recommendation. The biggest difference between a house that you live in versus a house that you're going to buy as an investment, the one you're living in, you probably only have to put 5% down, maybe 10% down. But if it's a property that you're investing in and it's an investment property, you're going to need to put 20 to 25% down. So there's a big difference in the amount of capital that you're going to need to purchase the property. But if you are looking for an investment property, here's a couple things to consider. First of all, if you're going to use a real estate agent, find one that has worked with investors before, either has owned investment property or knows what an investment is. Just interview 3 of those and just pick the one that you feel like is going to do the better job. But you need to work with someone that actually knows what they're doing, or they're going to waste a lot of your time and encourage you to potentially buy a property that's not going to be a good deal for you. Let's look at something a little bit more tangible. How do you know if it's a good deal? So first of all, my 14-year-old son asked me this same question as we're looking at some investment properties. He said, how do I know if it's a good deal? He basically asked me, what should the cap rate be on a project that I'm looking at? I told him, I said, your cap rate needs to be higher than your interest rate today. That's it. So how do you know if it's a good deal? The cap rate needs to be higher than the interest rate that you're paying on your long-term financing. This is called positive leverage. This is, you know, we don't live in California. We're not going to do neutral or negative leverage. There has to be positive leverage. And I'm going to tell you what that means. Positive leverage is when you buy a property, you're putting 20-25% down, and you're borrowing the other, let's say 75 to 80% from the bank. If you're paying the bank 5% in interest and you're getting, the property's giving you a 4% cap rate and that's negative leverage, that's bad. There are certain situations which potentially having negative leverage would be okay. If you're in an area that has really high appreciation, property values are going up super high, in some cases you would be okay using negative leverage on a property. There's some, like in California, that happens a good bit of the time. For the majority of the country and for majority of investors, you're really looking for positive leverage. Now, let me show you what that means. When you buy a property, let's say you purchase a property for $300,000, okay? Now, how much are you going to put down? Let's say you're putting 20% down. So this is your 20% right here. That's how much cash that you're bringing, and you're going to borrow 80% from the bank. You're buying this property, and let's say this property is a 6% cap rate. And you need to know how to calculate a cap rate if you're going to buy income properties, because they're valued off of a cap rate. So let's assume it's a 6 cap. So if you paid $300,000 cash on this property, took out your operating expenses, your net cash flow, or what's called your NOI, net operating income, you divide that by your all-in cost, you're going to get 6%. So a 6% first year return on your investment, assuming you pay cash for the property using no leverage whatsoever. So you need to calculate NOI to be able to calculate your cap rate. The point about leverage is if you do go and borrow money from the bank, and let's say interest rates today for long-term debt could easily be 6.7% interest. So that's what you're paying. So you borrowed 80% of that. So 20%, $60,000. So you borrowed $240,000 from the bank, 6.7% interest on that money, and you're receiving 6%. So are you making money or losing money? You're losing money. That's called negative leverage. So you don't want that. So if you go into Google and look up, okay, what are interest rates today for a long-term loan? And if it says 6.7, then you need to get a cap rate that's higher than that. So ultimately, we need to be at least at 7%. So this cap rate over here, 6%, doesn't work. We want to be at 7%. So for 7%, that means there's a little bit of a margin between your 6.7 and your 7%. You have a 0.3% margin. That's not a lot, but a margin's a margin. You're getting your 7% on your 20%, and you're getting 0.3% on the rest of it. When you add that 0.3 to your 7%, you may be like 8.2 or 8 point something percent. So that's what positive leverage does for you. It allows you to make more, a higher return than the cap rate. That's also what we call a cash on cash return. Cash on cash is otherwise known as a leverage return. Now I want to explain how to calculate the cap rate. So how do I know if this is a good deal? First of all, let's assume this $300,000 property is bringing in $2,000 a month. So you got $2,000 a month coming into the property. Now, out of that, it's grossing $2,000 a month. You've got to calculate your net operating income, or your NOI, so that we can determine the cap rate. So $2,000 times 12 is $24,000. Now you got to take out operating expenses. Operating expenses are going to be somewhere between 35 and 45% of your gross income on a single family residence. So if it's a newer home in a nicer area, you can use 35%. If it's an older home in a less nicer area, you can use 45%. So let's take, for example, $2,000 a month. Let's use, because we're buying a newer property, it's $300,000. Let's use 35% as our expense ratio. Now I want to get the NOI. I don't really want to calculate how much am I spending in expenses. I want to calculate how much money am I getting back in my pocket after expenses. So I'm going to use the reciprocal of 35%, which is 65%. So I know if 35% is going to be my expenses, 65% is going to be my cash flow or my NOI. So 24,000 times 0.65, there you go, $15,600. Okay, now I've calculated my net operating income. So if I want to see what my actual cap rate is on this property, let's take this $15,600 and divide it by 300,000, and that's 5.2%. So this is a whopping terrible 5.2% cap rate. If I buy this house at $300,000, that's bringing in $2,000 a month, that may have been a good cash flow, a couple of years ago. The market was really high, or maybe this isn't a great area and appreciates very well. But you always want to balance out your appreciation and your cash flow. Real estate is best, and it works best when you have both appreciation and cash flow. Okay, so we just said an interest rate today is going to be 6.7%. I can't buy a property 5.2%. I'm going to get negative leverage. So let's see what I can pay for this property at a 7% cap. So again, let's take our net operating income that we've already calculated, $15,600 a year, divided by 0.07, which is the cap rate that I do want. That gives me roughly $223,000. There you go. To get a 7 cap on this property, you cannot pay more than $223,000. Do you see that this is a big spread on a $300,000 house? $2,000 a month, $300,000 house. Hey, I live in the Southeast. That's not that far off. So you can see going from last year to this year has made it very difficult with interest rates going up to be able to get a good deal. Last year, interest rates were half of what they are today. It's a lot easier to find a deal. So right now, sometimes buying single family rentals directly can be really difficult right now. So we've got a fund that we've launched as a portfolio in there. There are other funds out there. You can invest in a fund that already has existing assets. It's difficult to find a good deal today, but you can find it. And sometimes you may have to buy a fixer up or put a little sweat equity into it.